Hey everyone, it's Denise Donahue, your mortgage nerd, bringing you your June 15th interest rate update. Interest rates have been so crazy this year, and it's always really important to me to be as transparent as possible, tell you guys what's going on with the rates, why it's going on. For those of you who have watched my updates before, you know that as a certified mortgage planner, in order to follow what's going on with mortgage rates and where they're trending, you have to follow the treasury bonds and what they're selling at, because fixed mortgage rates are directly tied to the bond market. Many people don't know that. You know, the Fed's just announced that they increased the federal funds rate. They're expecting to do that a couple more times this year. But the federal funds rate is not directly associated with fixed mortgage rates. Those rates are tied to car loans and credit cards and business lines of credits and home equity line of credits, but not directly your mortgage rates. So don't let that confuse you. Now, the emotional component of that is because people assume it has to do with rates, it causes fluctuation with bonds. So I'm going to give you a sneak peek. Let's take a look about what rates have done in the last 2 years and fast forward to where we are today. So for those of you guys that know, been following along, this is what the bond market has looked like over the last 2 years. You can see here that the bonds were trading at $107 a bond. That means you could sell a bond on the market for $107, and we were loving life back in 2016. This is when rates were in the 3% range, and everybody was happy. And then look what happens here. This is November 8th of 2016. Anybody know what happened at that time? We elected a new president, and when Donald Trump took over, we see a huge dip in the bond price, which is what caused interest rates to get to about that 4% range. And that's when people started freaking out. They were like, oh my gosh, when did rates get to 4%? These first-time home buyers, they've never even heard 4%. My other folks who have been around in the 80s know that interest rates were in the 14% in the 1980s. But the bond price dropped all the way below $104 a bond, which is why interest rates jumped up, because the bonds and the interest rates have an inverse relationship. So you can see over the course of 2017, there were some up and downs. And then we fast forward to this year. And everybody's been talking about rates this year, about how high they've gotten. I want to show you why. Here's why. In January 8th of 2018, that's where my mouse is hovering, you'll see that the price of the bond was around $104 a share. And then look what happened to this line. It just goes down, 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 up until about mid-February. We see that it got below $102 a bond, which is when we started seeing rates around 4.3, 4.5, mellowed out a little bit, and then boom, again in April of this, just a few months ago, we see another dip. Then we fast forward here. Look at this. This is the lowest point on this entire chart over 2 years. If I was to expand this over 6 years, literally this would be the lowest point in the last 6 years. And what does that mean? That means rates are the highest that they've ever been. They recovered a little bit, but they're still back down here. So where are rates today? Well, if you look over here next to my website, you'll see that I always post what Fannie and Freddie are lending at. So Fannie and Freddie are lending at 4.54, but that doesn't mean that's what the banks are going to lend you at, because the banks have to make their money somehow. So let's look at Wells Fargo. They're one of the 32 banks that we shop. They're advertising right now their 30-year fixed rate online, which means best case scenario. This is their 30-year fixed of 4.75. That's with 25% down. Of course, all the fine print says 25% down, great credit score, 1 discount point. That's their advertised interest rate. So if you're not putting 25% down and your credit score is below a 740, do you think that your interest rate is going to be higher or lower than this advertised rate? Probably higher. Most advertisements will have a best case scenario rate. So don't think that interest rates are still in the 3% range. They're not. 86% of economists are estimating that the mortgage rates are going to get over 5%, even with 25% down and a 740 FICO score. So make sure you're paying attention. If you have clients or if you're on the fence about buying a home, I've got a video on my video vault on my website that talks about the cost of waiting 1 year to buy a home with increased interest rates and purchase prices climbing. So get on this train. Here's an example of what a principal and interest only payment chart looks like. So if you have a $200,000 loan, again, this does not include taxes and insurance. But if your rate was 4%, your payment would be $955. If it goes to 4.875, look what it does to the payment. So interest rate affects your purchasing power. Stay in tune with what rates are doing. Make sure that you're not looking at fake news, they're looking at real news or nerd news. Appreciate you guys tuning in. Hope you guys have a great Father's Day weekend for all the fathers out there. If you guys have any questions, you know how to get a hold of me. Call, email, text, go online. All of my information is there. Y'all have a great weekend. Take care.